So today we're going to have probably the simplest class we'll have all year. It's really a review of some tax and depreciation issues that we're going to make use of the entire year, but it's fairly straightforward. So I wouldn't be surprised if we ended early today. And like all the other classes, the first thing I will do is start off with a problem. Why are we talking about this? And typically the problem I'll state is the problem of the case that you will do the following week. So for example, in a few weeks, the problem may be something like, should XYZ physician practice lease or buy its equipment? So that's the problem that we'll be talking about on that day. Today we're going to talk about the problem that's in, there is no case for today, but you will be doing a mini case in an hour or two. And the problem in that mini case is what will happen to the taxes paid by an insurance company if it sells some computer equipment. So it's a tax issue. And we're going to talk about taxes not because we're going to focus a lot on the for-profit sector, but it's important in finance to get an understanding of what are the situations under a for-profit setting, and then how do we relax those assumptions, or what do we do about it when we talk about a not-for-profit setting. So, why do we have taxes? Well, different kinds of organizations have got different stakeholders. All businesses, whether they're investor-owned or they're not-for-profit, have stakeholders. So stakeholders are defined as you see here. They have an interest, usually financial, but not always a financial in the business. Not-for-profit managers have to satisfy all stakeholders, whereas the managers of investor-owned really have the stockholders to answer to. They are the primary stakeholders. So what are stakeholders? What are some stakeholders of not-for-profit organizations, such as a hospital?
Board of Trustees.
Pardon?
Board of Trustees.
Board of Trustees.
The community?
The community.
Patients.
Patients. Employees.
Suppliers.
Suppliers. Creditors. Lenders. Potential patients. Government. All these organizations have a vested financial and community interest in the outcome of a not-for-profit organization. So for-profit and not-for-profit have very different financial goals. Investor-owned corporation, as anybody who's gone through the MBA program will tell you, the financial goal of an investor-owned corporation is wealth maximization. We want to maximize the price of the common stock, or the preferred stock. That is the most dominant financial goal. However, not-for-profits, the goal is not just finance. There are many other goals as well, but the primary financial goal is to maintain the financial viability of the organization. And to do this, I claim not-for-profits need profits. Why do I say that?
We need capital in order to gather assets or to invest in future projects to further develop the not-for-profit to service its community.
Exactly. Not-for-profits have the same demands for capital as for-profits do. We want to make sure our healthcare organization that we're managing has up-to-date equipment, has the buildings it needs to meet patient needs, can recruit good staff. Those require financial profits, or not surpluses, if you like, if you do not like the word profit. Do the financial goals lead to appreciably different behavior?
No. They don't, because, I mean, they have to be viable in either industry.
That's right. So there is, in fact, a lot of research that shows that the financial behavior of not-for-profits and for-profits are very similar. So tax laws. This is really going to be 50,000-foot view of tax laws. There are entire business degrees or degrees in business schools that deal with tax, where you basically people spend 2 years studying nothing but tax. So I'm going to cover this in 10 minutes. So it's a very 50,000-foot view of tax laws. Taxes are important because they influence financial decision-making. And for for-profits and not-for-profits, it affects financing decisions, whether we should finance a new building with equity or with debt. The operating cash flows that are available are affected by the level of taxation, and the ability to raise contribution capital. What is contribution capital? In a not-for-profit setting, what is contribution capital?
Would it be, for example, donations?
Yes, it's philanthropy, it's government grants, it's capital that is contributed to that not-for-profit organization without the sale of equity. So there are many different types of taxes, but we're going to talk about 3 different types: federal, state, local, personal versus corporate, ordinary versus capital gains. So all of you, when you graduate and you start earning big bucks, will be paying income tax, and you'll be paying federal and state taxes on your salaries, on their interests, and on dividend income, and any other income that you have, and those rates can be up to 50%. There are interest rates on non-federal government bonds, which are called munis or municipal bonds. They are issued by not-for-profit tax providers, and they are not taxable. So if you buy some bonds from UNC Healthcare or Duke or WakeMed, and you receive interest income off of those bonds, you get to keep all of that interest income. It is not taxable. Dividends generally are taxed at a lower rate than other kinds of ordinary income because they are perceived to be greater risk. So taxable versus muni bonds, because this is a key difference between for-profit and not-for-profit health providers. For-profit health providers issue taxable bonds, and non-for-profit providers issue tax-exempt bonds. So for example, let's look at this organization, FP, For-Profit Healthcare. It's a for-profit investor-owned organization. It has to offer the market rate of interest out there for its bonds is 10%. So Jane Green has a 28% personal tax rate. She buys one $1,000 bond. So 10% times $1,000 is $100 of interest per year Jane will receive from that bond. Does she get to keep all that $100? No, she does not, because Uncle Sam wants that tax. So in fact, out of that $100 check she gets in interest income, she will actually receive $72 of it, because she's got to pay a 28% tax on the $100 interest income. So the effective after-tax rate of interest to Jane is what?
7.2.
Somebody said it.
7.2%.
7.2%. FB Healthcare says, yes, we will pay you 10%, but the rate of return to Jane is actually 7.2%, because she has to pay 28% tax on the interest income. Now consider if it was a not-for-profit provider, and it can issue similar risk municipal bonds or munis, and that has an 8% interest rate. So should Jane buy the not-for-profit bond or the for-profit bond? So we can see at 8%, you can do the arithmetic here by looking at the rate at which they would be indifferent. You can see that 11.1% is the before-tax rate of interest that would result in an after-tax rate of interest of 8%. So Jane should be indifferent between an 11.1% taxable rate of interest issued by for-profit healthcare, or a 7.2% return by the not-for-profit. So personal taxes on capital gains. So ordinary income includes salaries and interest and short-term capital gains. Those are all taxed at normal interest rates, normal taxation rate. A second type of income is capital gains, capital losses. So capital assets are things like stocks, bonds, housing, plant, equipment, art, any asset that can be bought and sold for a gain or loss. If there's a gain, it's called a capital gain. If it occurs, if you sell it for more than the price that you bought it for, it's a capital gain. If you sell it for less than the price you paid for, it's a capital loss. Short-term capital gains are no different than interest income. Short-term is defined as less than 1 year. Long-term gains are taxed at lower rates. Capital losses can be carried forward and carried back. In other words, if you had taxable income last year on which you paid income tax, and you have a capital loss this year, you can carry it backwards to reduce your taxable income for this year. Similarly, if you had no capital losses in the past, and you have one this year, you can apply it to future years as well, up to 20 years.
George, going back one slide, did you mean 8% and 11.1% is when she should be indifferent? I think, or is it 7.2 and 11.1?
I'm saying the 7.2% is what Jane would earn on the for-profit bond. Here, 8% interest rate is what is the not-for-profit rate, and that essentially she gets to keep all that 8% because 8% is greater than the 7.2. She would prefer the not-for-profit bond. Sorry if that wasn't clear.
So the after-tax rate that you'd have to get the 8% would be 11.1.
Right.
Okay.
Corporate taxes, so investor-owned corporations will pay federal and state taxes on corporate income at rates up to 40%. Not-for-profit corporations, for the most part, are not subject to taxation. I'll talk about an exception to that rule in a minute. Plus, not-for-profit corporations have two substantial tax benefits. The first is the ability to issue tax-exempt municipal bonds. And that is a benefit. Why is it a benefit? Why do I, as a hospital or a not-for-profit provider of any sort, why would this be a benefit to me?
Because it's a source of financing that you have. So an investor would rather invest in your bond than in a taxable bond.
And
So that gives you an advantage on getting money easier.
okay, and it's easier, you're right, but I just want to push you a little bit more. What's the major difference between the for-profit bond and the not-for-profit bond I went through? To the provider.
They can get capital without it being taxed.
Not a better return.
Where was I? What's the rate of interest on the for-profit healthcare bond?
I can issue lower interest rates and it'd still be equally attractive.
Exactly. That you can issue bonds at lower rates of interest than you would have to offer otherwise if they were taxable. That is a huge financial benefit to being a not-for-profit provider. And secondly, they can receive tax-exempt contributions. So what that means is if I decide to give $1,000 to the Red Cross, I get a tax receipt for that contribution, and I get to reduce my taxable income by a certain percentage of the contribution that I make. So again, that is an incentive for not-for-profits and a help to them raising capital. The way the tax code is set up, again, this is fairly simplistic, but it's good enough for this course. Essentially, the way it works is that if there are an organization has taxable income between $0 and $50,000. There's a base tax of 0 plus 15% times the amount. So if you have taxable income of $30,000, the tax you pay is $0 on the base plus 15% times $30,000. If it's between $50,000 and $75,000, you pay a base tax of $7,500 plus 25% on the difference between your rate of tax, your income, and the bottom of the threshold. So let's just go through an example and show what we mean. Midwest Home has taxable income of $80,000. So we go back one slide. $80,000 falls in the $50,000 to $75,000 to $100,000 range. So the basic tax there is $13,750 plus 34%. So what we do, there's the $13,750, and we take 34% times the difference between the taxable income and the $75,000. $13,750, to do all the arithmetic, it turns out to be $15,450. What's the difference between marginal tax rate and average tax rate? Accountants, when you go get your income tax return done by an accountant every year, almost certainly he or she will tell you what your average tax rate was and what your marginal tax rate was. What does that mean?
The average tax rate is just the amount of taxes you're paying as a percentage of your entire income, and marginal is just the percentage you pay on an additional dollar.
Exactly. I can't improve on that definition. Unrelated business income,
Could you say that one more time?
I will repeat it. Marginal tax rate is the tax rate on every additional dollar of income you make. So if someone's making $80,000, if they make $80,001, then the tax rate that applies to that additional $1 is your marginal tax rate. The average tax rate is your total amount of tax over your total amount of taxable income. So you can see here, 34%, marginal tax rate is 34%. That's applying to the $80,000 minus $75,000. That's the amount of money above the base tax. The average tax rate is taking the total tax bill, the $15,450, and dividing it by the $80,000 of taxable income. So it's paying tax on each additional dollar it makes. It will pay 34 cents in tax. In total, its average tax rate is 19.3%, which means out of all of its income, it paid 19.3%. And the reason these two are different is because of this base tax. It's not a pure variable tax. Like if it was 34% on every dollar from zero, then the marginal rate and the average rate would be the same thing. But because we have base tax system, that's what results in the average tax typically being lower than the marginal. Question? Okay, not-for-profits will, particularly large health systems, large managed care organizations will often have unrelated business income. And what that is, it is a tax-exempt, not-for-profit organization has income from a business that is not related to its charitable goal, or it has carries it on as if it were a for-profit organization. Generally, UBI is taxed at the same rate as if they were a for-profit business. There are some exceptions. For example, if you have a cafeteria run by volunteers or sales employees and so on. But there are some taxes paid by not-for-profits. Interest and dividend income received by an investor-owned interest is the same as ordinary income. 70% of dividends is excluded. Why is that? Corporations pay dividends out of after-tax income. So they earn a certain amount of money, they pay all their taxes, and what's left over can go in the form of dividends to shareholders. So the income which generated those dividends has already been taxed. So therefore, the government, to avoid double taxation of income, the government allows 70% of the dividends to be excluded from taxation. So let's go through a quick example. A corporation has $100,000 of taxable income, has $55,000 of interest, and $10,000 of dividend income. The operating income is fully taxed. It's right there, full impact of the tax man. Interest income is $5,000. It's the same thing. It's ordinary income. And taxable dividend income is $10,000 times the 70%, or minus the 70%. 10,000 minus 70% times the 10,000 equals $3,000. So its taxable income will be $108,000. So again, going through the arithmetic, its total tax paid would be $25,370. Now, not-for-profits have interest and dividend income as well. Most hospitals will have foundations or have cash that it parks in investments of various sorts, and they will receive interest and dividend income from those investments. Typically, to a not-for-profit, that is not taxed. So all the profits that not-for-profits make from their investments, they get to keep without paying any tax on them. However, not-for-profits cannot issue tax-exempt bonds and then turn around and invest that money in the stock market. Uncle Sam would not like that. Why? Yeah.
Because not-for-profits are supposed to use their resources to fulfill their mission, and just making profit on the stock market would not be considered, I guess, appropriate.
And I think most people would agree with you. Uncle Sam has a more pecuniary interest, because what they would be interested in is money. And they would not like not-for-profits to do this, because what could a not-for-profit theoretically do? It could borrow $1 billion in not-for-profit bonds, turn around, invest it in the stock market, get very exorbitant returns, and all of those returns would be tax exempt. So not-for-profits are not allowed to issue tax-exempt bonds for the sole purpose. They are allowed to issue tax-exempt bonds and then park them temporarily in the stock market if it's towards a building fund or some other charitable purpose in the short term. But they're not allowed to be a hedge fund, which is essentially what they would be. Interest and dividend income paid by an investor-owned corporation. We covered that. Okay, so the last thing that we're going to talk about in this class is depreciation. And this will affect us from now until next May, because every time we do some sort of financial analysis, we have to take into account depreciation. What kind of an expense is depreciation? What do accountants call depreciation?
Non-cash.
Non-cash. What does that mean? Why?
It's not an actual cash outlay, it's just something that goes on your income statement that you have to add back later.
Exactly. So depreciation is a non-cash expense. So what does that mean? It means unlike your employees, where you write a check every 2 weeks to pay your staff, you do not sit back and write a check to depreciation. It's a non-cash expense. It's a tax-deductible expense because the government recognizes there is wear and tear to machines and buildings. So that has an implication for the taxation. So we've got two hospitals here that are identical in every way except their depreciation expense. Hospital A has only $100,000. Hospital B has $200,000 of depreciation expense. So that results in a different taxable income. The fact they have different taxable income, because depreciation is a tax-deductible expense, produces different taxes. $80,000 for Hospital A and $40,000 for Hospital B. That results in different after-tax income. So basically, what's happening here? Why are the net cash flows different to these organizations?
The higher the depreciation, the higher the net cash flow.
Right, so what's Hospital B got going on for it here? it's got a lot more depreciation than Hospital A. So it pays a lot less tax. That is called a depreciation tax shield. So what that means is that by increasing the amount of depreciation, if you buy a lot of capital assets, that increases your depreciation expense, that reduces your taxes, because depreciation is a tax-deductible expense. So at the bottom, you can see the after-tax income of Hospital B is lower than Hospital A, but then I add back in depreciation to get net cash flow. Why do I do that? What's the meaning of all that?
You don't tax depreciation, so you add it in after you tax everything else.
Right, so according to our income tax return, Hospital B is much less profitable than Hospital A because it had a lot more depreciation expense. Its net income is lower. Its after-tax income is lower. But in fact, depreciation is a non-cash expense. So if we want to know what the true cash flow is to this organization, we have to add back in depreciation to get the net cash flow. So yes, Hospital B is less profitable from a taxation perspective, but in fact, it has greater net cash flow when we add back in depreciation. So it's the net cash flow is really of what is greater interest to managers than the reported taxable income. You as managers will be most concerned with cash flow in and out of your organization's bank account. Manipulations that accountants do are important, but they are not always directly relevant to financial decision making, and I'll emphasize that over and over again. Here's a not-for-profit corporation. So I'm not going to go through it, just tell me what you think. What's going on here? Not the same result, is it? So why are the net cash flows the same?
There were no taxes, so there was nothing to be shielded from.
Exactly. There is no depreciation tax shield. If the tax rate is zero, then there is no depreciation tax shield. Both of these organizations have exactly the same net cash flows because there's no difference in taxes, there's no difference in depreciation tax shield. So for-profits and not-for-profits have very different incentives and financial realities around taxes and depreciation. So how is depreciation calculated? Well, accountants, when they're putting financial statements together, typically will use straight-line depreciation. Straight-line depreciation is the cost of the asset minus its salvage value. What is salvage value?
What you sell it back for.
Yes, what it's worth at the time of the asset's useful life coming to an end. Can anybody imagine a situation that being negative?
Maybe if you have like loans on it or something, and you can't use it anymore, but you still have to pay back, if you're loaning it or, that way, I guess.
Okay, the loan is typically not taken into account when you look at the value of the asset. Just like a piece of machinery or a building, regardless of how it's financed, what is its value? I'm asking whether you could see negative salvage value.
For some reason, there was no depreciation and the value of the machinery went up as opposed to going down. I don't know why that.
Okay, you're on an interesting track, which we'll talk more about in a minute. Julie.
I would say just zero. I mean, if it has no value, it has no value. How do you get a negative value?
That's what I'm asking you.
Sometimes in the case of medical equipment, for example, the salvage value is zero, but then you have to pay some engineer to take the equipment away from the hospital and dispose of it.
Exactly. There are lots, healthcare, hospitals in particular, have got a lot of dirty business, environmental concerns. Anytime you drive by a gas station, you see the place where an old gas station used to be, what do you see? digging up the ground, all the earth around it, because there's probably environmental damage. So, nevertheless, accountants will calculate the straight line depreciation by taking the value of the asset minus its salvage value over its useful life. So we have an X-ray machine, costs $100,000, costs $10,000 to deliver and install it, and it's worth $5,000 at the end of its life. Accountants will calculate a depreciation expense of $10,500.
My question had to be, you had an example where you had the two different depreciation.
Yeah.
I was wondering, what does it mean, like if you have a lot of depreciation, what does that mean for your organization? Like, does it mean like you have too much equipment or too old equipment? Like, what does that mean?
You cannot, that will be a great question to ask when we talk about financial condition analysis, when we talk about average age of plan and so on. Right now, there's no easy, simple way to answer that question. Some hospitals, some healthcare organizations overbuild, and they have very high depreciation expenses. Very high depreciation expense could indicate they have overbuilt. On the other hand, it could be that they've just got a very high-tech, high complexity kind of.
That'll last longer.
Right. No depreciation would be a very worrisome sign. I, as a patient, would not go to a healthcare organization with zero depreciation. Because that means essentially they've written off, all the equipment in that organization has been written off. So what they do, so this is how accountants calculate straight line depreciation. The value of the asset is $100,000. They add in the installation cost because that is the cost of acquiring the asset. And it's going to be worth $5,000 when they get rid of it. So they divide that by 10 years. So $10,500 is included as a line item on the income statement of the organization every year. There was $10,500, and they will do that for how many years? 10. For 10 years, and then the value of the asset is 0. And it's written off. It's removed from the books. Uncle Sam has a different method. The federal government, the IRS, has a system called MAKERS or MACRS, depending on where in the country you grew up. And it's called a Modified Accelerated Cost Recovery System. And this is used for tax purposes only. The standard method, the alternative method. I'm going to only go through the standard method. The standard method includes 3 components. The depreciable basis, which is what is the total amount to be depreciated. Salvage value is not recognized by the IRS. So that's an important difference between the accountant view of the world and the IRS view of the world. It's just the capital cost of the asset. The recovery period, or the class life, which is the number of years over which the asset is going to be depreciated. And finally, the recovery allowances. This is the annual amount that the federal government allows you to write off, to reduce your taxes by writing it off. So let's go through this. The same example. We have an X-ray machine, $100,000, $10,000 to deliver, install, falls into MAKERS 5-year class. Now this asset uses a 5-year class, even though it may only last 4 years. So what the half-life, half-year convention means is that when you buy an asset, typically you will not buy it on January the 1st of the year. You will typically buy it some portion of the way through the year. So the depreciation of the asset, even though it's going to last 3 years, it will cover 4 taxation years. So that is why the government says if you've got an asset that's going to last 3 years, we depreciate it over 4 years. If you have an asset that's going to last 10 years, we depreciate it over 11 years. And here are the basis. This is the MAKERS data. This is an asset that lasts 5 years. We're going to take the $110,000, and there are the different allowances per year. So what that means is the following. The $110,000 is the depreciable basis. It's the value of the asset, capital cost of the asset. 20% of that is $22,000. So the IRS will allow this organization to include $22,000 of depreciation expense on its income tax statement that year. The book value is then $88,000. What does that mean? How's that calculated? Where's it coming from?
Subtracted it. Basis minus depreciation.
Right, so what that means is at the beginning of the tax year, the asset's worth $110,000. At the end of the tax year, you've claimed $22,000 depreciation, so the value of the asset is now only $88,000. So that $88,000 is the book value at the end of the first year. At the beginning of the second year, 32% of the $110,000 is allowed, so that's $35,200. And again, the book value then falls to $52,800. You can see as it gradually goes down to the end of the sixth year, where the book value is zero. So from the IRS perspective, you've written it off at the end of the sixth year. So one of the interesting questions is then, what happens if this organization, at the end of the third year, what is this asset worth according to the government? $31,900. What happens if the organization sells the asset for $40,000?
They're taxed on
What do they get taxed on?
it, the difference,
Okay, why?
because they, I guess, overestimated how much the depreciation would be, so now it's a income tax.
It's a capital gain. That's right, that's the right explanation. If the government says the asset's worth $30,900 at the end of the third year, and they sell it for $40,000, essentially there is a capital gain of $8,100, and that will be taxed when they go to submit their income tax return. They will have to include $8,100 capital gain. They will pay tax on that. What happens if the asset is worth $31,900 and they sell it for $20,000? Say what?
A discount later. It comes
Discount
back.
later. Tell me what you mean by that.
So from what I understand, then you wouldn't have as much tax on your, like it would be subtracted from your income, and then you wouldn't be taxed as much on the overall.
Right, so the opposite to a capital gain is a capital loss. Because what that means then is that you haven't taken enough depreciation, and so you can claim that as a capital loss in your income tax. At the beginning of the recession, the president, one of the things he did was he changed those allowances for many kinds of assets for healthcare organizations and other corporations as well. Instead of 20, 32, 19, 12, 11, and 6, he had 100, 0, 0, 0, 0, 0. Why did he do that?
Can you say it one more time?
Sorry?
So if after the first year, then the book value of the machine or instrument will be zero, and then if you happen to sell it or do anything with it, then it'll be considered a capital loss because it's only worth zero at the end of the year?
Okay, you're circling around it. Circling.
Because companies that sell equipment after the first year, they will pay capital gain tax.
Okay, if that was 100%, how much would the organization, probably,
So your tax shield, depreciation tax shield would go through the roof, and that's like an influx of money to your organization.
okay, and what would that do? You're right, that's,
Allow you to invest that further in the organization.
and how would the president benefit? What did the president see, why did he do it?
Helps money with the economy.
Yeah.
In what way? You're
Well,
right.
you know, by buying and selling resources.
Exactly.
It's jumpstarting the economy.
Exactly, by making that 100, 0, 0, 0, 0, 0, that gave corporations huge financial incentive to go out and load up on capital equipment. That's providing a stimulus to the economy. So these look like just numbers and tax rates, but in fact, there are huge financial incentives built into the tax system. And again, this is just a 50,000-foot view of it. But that's what I'm trying to convince you of. Okay. Here are 3 practice problems. These are very similar to the RAT questions you're going to answer in a few minutes. True or false? It is true. That's one of the major benefits of having tax exempt bonds. But this one's tricky.
It's sort of B and D, right?
D is incorrect? You think D?
Oh, that's true. Yeah, they didn't necessarily count.
Somebody hollered out the right answer.
D.
D. So it increases its taxable income. This is capital goods. Is that true or false?
False.
False. Because why? Right? And interest is a tax deductible expense and dividends are not. Okay. Questions, comments?
I was just going to ask, can you review why number 2 or practice problem 2 is B, just real quick?
Sure. Essentially, if a business sells an asset for more than its tax book value, so in an example I talked about a few minutes ago, they sell the asset for $40,000 when its tax book value is $31,900. That means there's a capital gain. So the difference between the 40 and the 31,900, the $8,100, that will be reported as income on the firm's income statement, and they'll have to pay additional tax. So it increases its taxable income because there's been a capital gain.
What's the logic behind taxing long-term capital gains at a lower rate than short-term?
Asking about logic in the tax code is often a difficult question to answer. The basic notion is that when I'm buying and selling trades, when I'm buying and selling bonds, weekly, daily, and so on, that's really no different than buying or selling securities, shares, and so on. The long-term versus the short-term distinction is, if I'm investing in something long-term, then I'm taking well, it's really what I said a minute ago. It's more. It's really looked at as a liquid asset versus a permanent long-term asset, and particularly these days when a lot of assets are traded hourly and sometimes by the minute. So that's the basic reason. One is really no different than ordinary income, and one is more of seen as more of a long-term investment, essentially to reward people for holding on to assets for a long period of time, for investing in a corporation over a long period of time. It's a financial reward.
So if the useful life of a piece of equipment is 8, but the MACR or whatever it's called was a 5-year, that means there's 3 years where you essentially are going to have capital gains, or no?
No, the makers, the depreciable, the class that it's in, it's assigned a class when the day the asset is bought. So the IRS is a long last, like tractors, 5 years. Whatever tractor you buy, that will be depreciated using a MACR's 5-year class. And whether you sell it after 1 year or 5 years or 10 years, essentially the 5-year class will always apply to tractors.
But because it's 0 at year 6, if you sold it for anything then, it's considered a capital gain, right?
After anything you sell it for after the full, yes. Anything you sell it for after it's been fully depreciated, if that amount is greater than, I'm not sure how many tractors that are 8 years old are going to be sold for much beyond the price anyway. But you're right, there will be a capital gain. If you declared that tractor as a cost of doing business. If you're a taxable corporation, the answer is yes. Other questions or comments?
So, for that, like for the tractor example, even if like, so your tractor doesn't work anymore and someone comes and pays you for like salvage yards or something like that, they would still tax you on that money that they paid you for coming to get that? Or?
Any money you receive in excess of the depreciated capital cost of the asset is a capital gain.
When calculating depreciation, straight line depreciation, why would accountants use the salvage value in their equation when Mackers doesn't use salvage value? What's the benefit of incorporating that in the number?
Well, accountants would say, well, why doesn't the government incorporate salvage values?
Yeah, right.
The other way. The accountant's view of the world is that if there is a salvage value associated with an asset, then that essentially reduces the capital cost of the asset. And therefore, we're only going to depreciate the net effect of the capital cost. The government basically says, we want you to fully depreciate the asset between day one and day X. And if it doesn't, then we're going to retrospectively either reward you or penalize you. Again, I'm not very good at explaining the logic of the tax code and why it differs from accounting practices. Other comments or questions?
In the example that you talked about where the government changed the Mackers numbers to 100%, did that stimulate only the for-profit sector and not the not-for-profit? Because basically that we said is increase the tax shield, right? So did that do anything to the not-for-profit businesses?
Indirectly, because as we'll talk about in a few weeks when we talk about leasing, one of the major advantages to leasing is that not-for-profits can take advantage of the depreciation expense of the for-profits. So leasing companies were able to go out and buy lots of capital at very low cost, and then the benefits of that were not-for-profits got to lower leasing rates as a consequence. Now, there's not been a lot of empirical financial research yet that shows the net effect of this. I'm really telling you anecdotes or what I've read and heard about. There's no definitive study that can point to. Other comments or questions? Okay, let's take a 5-minute, 7-minute break, and then we'll come back and we'll try your first draft.